Hello, ladies and gentlemen. Imagine being 12 years old, caddying at a local golf course, and overhearing conversations about stocks and investments. That was me. I took my caddying earnings and bought shares of Northeast Airlines because it was the only stock I could afford at under $5. It tripled in value. That experience didn't just make me some money. It sparked a lifelong obsession with understanding how the world works. When I look back at where it all began, I realize how little I knew, but how important that ignorance was. It created curiosity. I wasn't born into a wealthy family. My dad was a jazz musician, and my mom was a homemaker. We lived in a middle-class neighborhood on Long Island. It was a normal life. I had no idea what the financial markets were or what investing really meant. I didn't grow up around bankers or traders. What I did have was a natural interest in understanding how things worked and an appetite for figuring things out on my own. I was about 12 years old when I started caddying at a local golf club. That experience turned out to be more valuable than I could have imagined, not because of the money, though that mattered too, but because of what I overheard, conversations between wealthy, successful men talking about stocks and markets. It was a whole different language, one I didn't understand but was drawn to. I remember one of them mentioned a stock called Northeast Airlines. I didn't know much, but it sounded interesting, and more importantly, it was cheap, under $5 a share. That meant I could afford it. So, I saved up the money I earned from caddying and bought a few shares. That trade tripled in value. It could have been luck. In fact, it probably was, but to me, it didn't matter. That moment lit something in me. I realized that investing wasn't just about numbers on a page. It was about betting on ideas, about understanding the cause-effect relationships in the world, and having the conviction to act on them. I was hooked. The excitement wasn't just in making money, it was in figuring out how the machine worked. That curiosity, more than anything, is what drove me forward. From that point on, I started reading everything I could about markets. I'd listen to the financial news, pick up whatever books I could get my hands on, and keep asking questions. I started to realize that markets are just like puzzles. If you can understand what's driving them, interest rates, economic cycles, investor psychology, you can anticipate movements, you can prepare. But you have to be deeply honest with yourself about what you know and what you don't. I learned that early on. Being wrong is part of the process, but being blind to why you're wrong is fatal. In school, I wasn't the top student, but I was always trying to connect ideas. I didn't want to memorize things. I wanted to understand principles, why things happen, not just what happened. That mindset led me to college and eventually business school. But even there, I found that the most important lessons didn't come from lectures. They came from experience, from getting my hands dirty, from making mistakes. And I made a lot of them. But each mistake taught me something. If you can see pain as a signal, as feedback, rather than failure, you'll grow. I learned that every setback contained a lesson about myself, about my thinking, about reality. The earlier I could identify where my thinking was flawed, the better I became. What that first trade, buying that airline stock, taught me wasn't just that stocks go up and down. It taught me that if I paid attention, if I remained curious and humble, and if I stayed open to learning, I could get better. That first spark, that first win, wasn't the end of something. It was the beginning of a mindset, one that says the world is knowable, but only if you're honest enough to seek truth, rigorous enough to examine your beliefs, and brave enough to test them in the real world. People often think success starts with having some special knowledge or skill. It doesn't. It starts with being open. It starts with not pretending you know more than you do. It starts with looking at the world like a puzzle and being relentless in your desire to understand it. That mindset, born out of a lucky break, some overheard conversations, and a few shares of a forgotten airline, is what built the foundation for everything that came after, not because I got it right, but because I was willing to learn when I got it wrong. And that's what it's all about. Starting something from nothing teaches you things no textbook can. When I launched the firm, I had no grand plan, no roadmap. There wasn't some big team or a huge office waiting. It was just me in a small apartment, trying to turn what I understood about the economy and markets into something real. What I did have was conviction in the idea that understanding how things work and turning that understanding into a strategy could be valuable. In the early days, it wasn't glamorous. I was making cold calls, writing research reports, giving advice to people with more experience and money than I had. But that was the process: learning, improving, refining. I'd wake up every day and try to understand what was happening in the world. Interest rates, inflation, supply chains, currencies, politics, how they all interacted. I wasn't trying to guess. I was trying to connect dots. That desire to understand the cause-effect relationships that drive economies and markets was at the core of everything. At first, I focused on currencies and interest rates. Those were areas where I felt the most confident in my understanding. The clients weren't massive institutions. They were small businesses, people trying to navigate risk in a world that was becoming more complex. I didn't have a name they knew, so I had to earn trust. That trust came from being useful, by helping them see what was coming, why it was coming, and what they could do about it. That process of serving clients forced me to sharpen my thinking. When someone's decisions rely on your insights, there's no room for fluff. You either know what you're talking about, or you don't. Of course, it didn't all go smoothly. I made some bad calls. I remember making a bold bet on a market move that didn't happen. I was confident, but I was wrong. And it was painful financially and emotionally. But instead of hiding from it, I wrote down what I learned. Why did I make that decision? What assumptions led me there? How could I stress test my thinking next time? That's where the real growth came from, being honest about mistakes and systematizing the learning. As the years went on, the firm grew, not explosively, but steadily. It grew because people saw value in the clarity we provided. I didn't want to build just another investment shop. I wanted to build a culture that valued truth, that rewarded people not for being right, but for being open-minded and rigorous in their thinking. We started developing tools to record and challenge our ideas. Every meeting, every forecast, everything was on the table for examination, not to prove who was smarter, but to get closer to the truth. That approach became our foundation. We weren't afraid to ask difficult questions or confront uncomfortable truth. In fact, we welcomed it. Over time, this led to the development of principles, clear, documented ways of thinking that helped guide decisions and behavior. These weren't vague ideas. They were the distilled lessons from years of success and failure. And they became embedded in the DNA of the firm. Eventually, we started working with large institutions, governments, pension funds, central banks. But we never changed our core approach. We stuck to our belief that by understanding the big picture and building diversified portfolios based on fundamental insights, we could deliver value. We weren't chasing the market. We were trying to understand it. There's something powerful about building slowly, based on substance. It forces you to focus on the long term, on durability, on quality, and it also forces you to develop humility, because in markets, The moment you think you can't be wrong is the moment you're most vulnerable. That's what the early years taught me. They weren't about wealth or status. They were about discovery of what works, what doesn't, and how to create a repeatable process out of that learning. Starting the firm wasn't about building a business. It was about building an idea that through deep understanding, transparency, and constant improvement, you could create something that lasts, something that adapts, evolves, and continues to learn. And if you do that, if you build from principles, if you let reality be your teacher, and if you surround yourself with people who challenge your thinking, you can build more than a company. You can build a system that keeps getting better. That's what I set out to do, and that's still what it's all about. If you're going to navigate the markets successfully, you need more than opinions. You need a system. You need a way of seeing the world that doesn't rely on guesswork or emotion, but is rooted in logic, in principles, and in patterns that repeat throughout history. That's the frame of mind I had when I started to realize the limitations of conventional investing. Diversification was supposed to protect you, but what I saw time and again was that people weren't really diversified. They thought owning 10 different stocks or funds meant they were safe. But if everything is correlated in a downturn, then you're not diversified at all. You're just exposed in more ways. That's what led me to think in terms of risk, not just assets. The idea wasn't just to spread investments across categories. It was to balance the actual sources of risk. I began to ask a different kind of question. How do you build a portfolio that can survive and thrive across all economic environments, inflationary booms, deflationary busts, rising growth, declining growth? Every asset class responds differently to these conditions. If you can balance them right, you can build something that doesn't depend on predicting the future perfectly. You're not betting on being right. You're preparing to be resilient. That's how the idea of the all-weather portfolio came into being. The concept was simple, but it challenged traditional thinking. Most portfolios were heavily reliant on economic growth, stocks, credit. When growth slowed or inflation rose, they got hit hard. But by combining assets that perform well in different conditions, like equities, bonds, commodities, and inflation-linked securities, you can smooth the ride. What matters is not how much of each asset you have, but how much risk each contributes. It took time, experimentation, and a lot of backtesting, but the result was a more robust, more dependable portfolio. One that wasn't trying to outperform in any one environment, but one that could endure all environments. At the same time, we were developing active strategies too. Strategies built around understanding the fundamental forces driving markets. We called it pure alpha. The idea was to generate returns that were uncorrelated with the broader market. That meant finding opportunities wherever they existed, in currencies, interest rates, equities, commodities, and making decisions based on deep research and global macroeconomic insights. Again, the goal wasn't to be clever, it was to be systematic. Every decision needed to be grounded in a clear logic, supported by data, and stress-tested through time. We started building models, decision rules that could be expressed in algorithms. The goal wasn't to remove the human element, but to reduce bias, to take the principles we developed from years of thinking and convert them into repeatable processes. The advantage of that is enormous. It forces clarity. If you can't explain your decision in a way that a computer can follow, you probably don't understand it well enough. So we built systems that made decisions based on the same kinds of reasoning we use: only with more discipline and without emotion. That approach gave us the ability to scale, to look across markets globally, to monitor hundreds of indicators in real time, to test thousands of scenarios, and most importantly, it gave us feedback. When something went wrong, we could go back and see exactly why. We weren't relying on gut instinct. We were building a machine, one that learned and evolved. But you can't just rely on the machine. You have to constantly test your assumptions. You have to stress test your portfolio against historical periods, against extreme scenarios, against your own blind spots. That's what innovation really means. It's not about creating something flashy. It's about continually refining your understanding, challenging your own beliefs, and being willing to change your mind when the evidence demands it. A good strategy isn't static. It adapts. The world changes, cycles shift, politics evolve, human behavior reacts. So your strategy has to be dynamic. That's why I always come back to the importance of principles. If you're guided by timeless, universal truth, cause and effect relationships that hold up across time, you'll be in a much better position to navigate uncertainty. In the end, that's what innovative investing is all about. It's not about having the smartest take. It's about building a framework that allows you to absorb information, make decisions, and adapt continuously. It's about clarity, logic, and most of all, humility, because markets will humble you. But if you approach them with curiosity and rigor, they'll also teach you. One of the most important lessons I learned early on was that success, whether in investing, managing a business, or navigating life, isn't about being right all the time. It's about being open to the truth, about embracing reality, no matter how uncomfortable it might be. That insight led me to develop a set of guiding principles, not just rules, but fundamental truths about how the world works and how people operate within it. These principles became the foundation for everything I did, because without principles, decisions are just shots in the dark. The challenge is that principles are only useful if they are understood deeply and applied consistently. It's easy to say, be honest, or tell the truth, but much harder to create an environment where people actually do that, and where they feel safe and encouraged to do so. In most organizations, people hide mistakes, avoid uncomfortable conversations, and protect their egos. That's natural, but it's also fatal if you want to build something that lasts. So, I started experimenting with radical transparency. This idea is simple in theory, but hard in practice. Create a culture where everything is on the table, where people are expected to be brutally honest with each other and with themselves, where feedback is constant and open, where mistakes are not punished, but dissected and learned from. The goal was to replace hierarchy with meritocracy, where the best ideas win, not the loudest voices or the highest titles. This approach required redefining trust. Trust isn't blind loyalty. It's a shared belief in each other's good intentions and intellectual honesty. People have to trust that when they speak up, they won't be attacked, but heard. And when they are challenged, they'll respond not defensively, but with curiosity and openness. That's the essence of an idea meritocracy. One practical way we implemented this was through tools and processes that encourage openness. We recorded meetings so that anyone could review them later. We used technology to track decisions and disagreements. People rated each other's contributions, and radical honesty was rewarded. It sounds intense, and it was. But over time, it created a culture where people weren't afraid to surface bad news or challenge assumptions. That changed everything. When you're operating in this kind of culture, the quality of decision making improves dramatically. Problems get identified early before they escalate. Misconceptions are corrected quickly. And most importantly, people learn faster because they see their blind spots more clearly. This isn't just about being transparent with others, but being transparent with yourself. Self-reflection is crucial. You have to be willing to look at your own weaknesses and biases without flinching. I realized that the biggest obstacles to learning aren't external, they're internal. Our egos, our emotional attachments, our fear of being wrong. Radical transparency helps strip those away. It forces you to be clear-eyed about reality, and in markets, in business, in life, clarity about reality is everything. But this philosophy goes beyond just culture. It shapes how you approach problems and make decisions. It means constantly questioning your assumptions, being open to data that contradicts your beliefs, and building systems that promote truth-seeking. It means designing processes that don't just tolerate disagreement, but celebrate it, because the truth rarely lives in consensus. It lives in debate, in testing, in challenging. Over time, these principles became codified, not as vague ideals, but as actionable guidelines that anyone could follow. They formed a kind of operating system for how we think, how we interact, and how we make decisions. Principles like believability, weighted decision-making, where the opinions of people with a proven track record in a specific area carry more weight. Or radical open-mindedness, which means constantly exploring alternative perspectives and being willing to change your mind. These aren't just theories. They're practical tools that, when applied consistently, lead to better outcomes. Because at the end of the day, success depends on your ability to see things clearly, to learn from mistakes, and to adapt quickly. And you can't do that unless you're operating with radical honesty and transparency. This approach also changes the way you view leadership. Leadership isn't about having all the answers or exerting control. It's about creating the conditions for truth to emerge and for people to do their best work. It's about humility, recognizing that no one person can know everything, and that the collective intelligence of a group, harnessed through openness and rigor, is far greater than any individual. The road isn't easy. It requires discipline, courage, and a willingness to endure discomfort. But the payoff is profound. When you build an organization or a life based on principles and radical transparency, you create resilience. You create adaptability, and ultimately you create lasting success that isn't dependent on luck or charisma, but on truth. This is a lesson that applies far beyond investing or business. It's a universal truth. If you want to thrive in a complex world, you have to be radically honest with yourself and with others. You have to embrace reality as it is, not as you wish it to be. And you have to build systems and cultures that relentlessly pursue truth. That's what leads to real growth, real progress, and real achievement. Understanding the economy at a macro level is less about having a crystal ball and more about recognizing patterns, cause and effect relationships that have played out repeatedly across history. The economy isn't a random collection of events. It moves in cycles, driven by forces that are both predictable and understandable if you step back far enough and look objectively. That's where the real power lies, not in guessing the next headline, but in grasping the underlying forces shaping markets and economies. One of the biggest insights I came to early on was that economies go through long-term debt cycles in addition to the short-term business cycles everyone talks about. Business cycles last a few years. They are about expansions and contractions in growth, largely driven by changes in spending and production. But debt cycles can last decades. They're about the accumulation and eventual deleveraging of debt, credit expanding during good times, and then contracting when the burden becomes unsustainable. When debt levels rise faster than income growth, eventually something has to give. You get a crisis, a recession, a financial crash, or a period of stagnation. Understanding where an economy is in that debt cycle is critical to predicting what's coming next, but it's not enough to look at debt alone. You have to look at interest rates, inflation, government policies, demographics, and the global context. All of these factors interact in complex ways. One key point is that central banks and governments don't just sit on the sidelines during these cycles. They intervene aggressively, often with unintended consequences. They lower interest rates, print money, or change regulations to try to stimulate growth or contain downturns. These actions can temporarily postpone the inevitable, but they also create new risks and distortions. Understanding these interventions, their motives, and their limits is vital for predicting how economies and markets will behave. Another critical factor is the global interconnectedness of economies. No country exists in isolation anymore. Capital flows move across borders. Trade relationships, geopolitical tensions, and currency dynamics all play major roles. Sometimes a problem in one region can trigger reactions worldwide. To see the whole picture, you have to think globally, not just domestically. One of the biggest mistakes people make is to focus only on the near term, to get caught up in earnings reports, quarterly GDP numbers, or the latest political drama. Those things matter, but they're often just noise. The real signals come from understanding the structural forces. Where are we in the cycle? What policies are shaping incentives, and what demographic trends are unfolding? Those are the factors that set the stage for what's possible and what's probable. That's why we developed frameworks and models to analyze these forces systematically. We didn't want to rely on hunches or superficial analysis. Instead, we created tools that could quantify risks, test scenarios, and forecast outcomes based on the interactions of multiple variables. These models are not perfect, but they provide a disciplined way to think about complexity and uncertainty. They help cut through emotion and bias. Economic predictions, in this sense, are less about certainty and more about probabilities and ranges of outcomes. You never know exactly what will happen, but you can prepare for multiple scenarios and position accordingly. That's the essence of risk management, not betting everything on one view, but diversifying and hedging to survive the surprises. It's also crucial to recognize that markets often behave irrationally in the short term. They're driven by human emotions, fear, greed, hope, and panic. These emotions can create bubbles and crashes that defy logic. But even then, these market moves are not random. They follow patterns rooted in psychology and herd behavior. Recognizing those patterns helps you avoid the traps and capitalize on opportunities. One of the reasons I emphasize principles and transparency so much is because you need a clear framework to interpret this complexity. Without a coherent system, it's easy to get overwhelmed or misled. When you have a set of principles and models guiding your thinking, you can better separate the signal from the noise. Predicting economic turning points isn't about being a fortune teller. It's about seeing the big picture and being willing to change your mind as new data comes in. It requires humility. No model or framework will work perfectly all the time. But if you keep learning, keep testing, and keep refining your views, you can stay ahead of most. Finally, one of the most important things I've learned is that history doesn't repeat exactly, but it often rhymes. By studying past cycles, you can gain valuable insights into present challenges. That historical perspective grounds your predictions and prevents you from falling prey to the illusion that this time is completely different. So, the path to reliable macroeconomic insight is a combination of deep study, disciplined frameworks, awareness of human psychology, and continuous learning. It's not flashy or easy, but it's the only way to navigate the complexity of today's global economy successfully. When you embrace this mindset, you become less reactive and more proactive. You don't just survive the storms, you learn how to sail through them. In the end, my journey has been about curiosity, learning, and adapting. From a curious kid with a few dollars to invest, to leading a firm that navigates complex global markets, the principles remain the same. Seek the truth, understand the mechanisms at play, and make decisions based on that understanding. It's a continuous journey of learning and growth.